Hi there, this is John Thompson, team leader at Simple Mortgage. Thanks for tuning into this day's lesson, More Smart Lesson. Today we're going to be talking about mortgage advertising and the fine print in mortgage advertising. So let me get going here. All right. So, at the end of it, we all know what advertising is. It's designed to make the phone ring, get you in the door. It does not always reflect reality. And this obviously happens in mortgage pricing ad. You've all seen them. They're on TV, they're on the radio. They seem really good, and they can be if you happen to fit in the box. But in this quick lesson, we're going to show you how to be educated, understand why lenders advertise it this way, which is to make the phone ring, what is in that fine print box, and how to get that advertised low rate, and then what's kind of in there, right? So how do we kind of work through those things, and what's it really mean, right? So first, the ads are designed to really make the phone ring. Very few callers actually get that rate, sort of like the special that you hear that traveling to Hawaii for $100. And no one gets that, but you call it to find out what the deal is. All right, so should you call? So how do they pay for the cost? So essentially, just to understand how lenders pay for costs. So let's just say you had a 3.25% rate, and there was a credit from the lender of about $3,500. Your costs are $3,500, and so there's got to be a credit to pay those costs, because costs exist. People do work; they got to get paid for their work. But the lender's paying for it instead of you paying for it. So how's it paid for? So we come over here to 3.25%. This is today's pricing. And you'll see that if you fit in the box, you get this credit of $2,300. On top of that, lenders being paid about 1 or 2% of the loan amount. So they've got $3,000 to $6,000 plus $2,300 to kind of play with. So of course they can pay your $3,500 in costs. So that's how they pay the costs. All right. So what's in the fine print? You got to have a really great credit score. You have to have a loan amount above $300,000, but under $510,000, because that's where the best pricing is across the nation. Once you're outside of those parameters, it's not going to work. Impounds are required, meaning they're going to collect your taxes and insurance. You don't do those, there could be an 1/8 to 1/4% in fee. It's got to be a purchase loan, or it's got to be a cash out, no cash out refinance. If you're taking cash out, this is a risk to the lender. They're going to charge you more to do that, right? And then oftentimes that advertising a 30-year fixed, but more often than not, it's also a 15-year fixed, which has a much lower interest rate than the 30-year fixed. But you may not catch that in advertising, and you call, well, I can't afford a 15-year fixed. That's not what I want. And all of a sudden you're kind of out of luck there, right? So kind of like this free cheese little piece here. So any deviation from those parameters and all the bets are off. But what they want you to do is complete an application, start the process, and now it's kind of hard to change what you're trying to do. That's what their goal is. And of course, my question is always going to be, well, what about the advice? What should I be doing about advice? Because it's not going to happen in that situation. So let's say you missed the FICO score. That first example was going back here, 3.25 at no cost. All right. So what happens if you miss the credit score? So now your rate goes up to 3.375, and you potentially don't get the same credit. So instead of $35 in credit, you're getting about $800 in credit. And here's live pricing right here. I put in the parameters, and you can kind of see the difference here. So that's if you miss a credit score. What if you want cash out and you want a loan amount over that 510? You want a $600,000 loan, which is where a lot of people in our local market live, right? So now your interest rate goes to 3.625. So forget about the 3.25. Now you're 3.625, and there's costs, not a credit. Now there's costs to get to that, and you just kind of see the live pricing over here. And let's say that you're not at under 60% loan to value, which a lot of people don't have that much equity if they bought their homes in the last 5-7 years. So now you're at 80% loan to value, like the majority of our clients. Okay, so now your interest rate is not 3.25, it's 3.375, and your lender credit drops from 3,500 down to 1,281. Okay, so that's the impact, kind of how it affects you everywhere. So once again, advertising really is a tool designed to get the phone ring. It happens in mortgage pricing like everyone else. You just need to be educated to understand what it means. Understand there is no free lunch, and if you do happen to fit in the box, then great, that might be great. But are you going to get any advice, and how's the process going to be? They advertise it because that's how they get the phone to ring, and they get you in process. They want to get an application, start the process, and then you can't move. I've quickly explained what's in the box, but in the box is loan amount, credit score, impounds required, the term, 30, 15-year kind of term, and then cash out. You can't take cash out. So those are the things to kind of watch for, and I appreciate you kind of listening in. I want to quickly remind you that we have, sorry, thought I had it right in front of me. Our Borrow Smart, Repay Smart book. If you want a free copy anytime, just give me a call and I'll send you one. Thanks very much. Have a great day.